Hello and welcome to our new investment strategy update. 2025 has imposed a dramatic paradigm shift on the world. Multipolarity means two major sources of uncertainty: geopolitics and trade. The US economy has moved away from its exceptionally strong growth towards a self-inflicted slowdown. And the first signs of weakness are emerging in the labor market, while positive news on inflation is set to be tested as tariffs hit activity and consumption. Corporate America has seen its business conditions deteriorate. Faced with tariff uncertainties, firms are slowing their hiring and postponing capital investments. With the highest US import tariffs dialed back by the Trump administration for now, inflation should stay below 3.5% this year. The Federal Reserve is finding it difficult to simultaneously ensure price stability and prevent stresses in the job market. Weaker employment means both slower consumption and slower growth. But let's be clear, although policy uncertainties have hurt the economic outlook, there is no reason for the US to slip into recession. We think the Fed will move its policy rate from restrictive into neutral territory this year, lending support to activity, and US GDP should rise by 1.2% in 2025. Meanwhile, the Eurozone should expand by around 1% this year, despite the region's massive commitments to invest in infrastructure led by Germany. But this is a major shift for Europe, as it is forced to adjust from global interdependence into autonomy. Of course, autonomy is much more expensive than interdependence, and decades of European underspending on infrastructure and defense will take time to catch up. But Germany's wake-up call is a game changer for global investors. With the European Central Bank's rate-cutting cycle almost complete, real rates, adjusted for inflation, are already negative. That means that US rates will stay much higher than Europe's for many months. Switzerland offers a very different picture, with the Swiss National Bank revisiting zero rates. This is where the easing cycle should stop, with negative rates only used as a last resort if the franc strengthens more or the economy deteriorates. In China, we expect more fiscal measures to counter disinflation, support the real estate sector, and loan demand. The pause, agreed with the US, has softened the impact of tariffs, but import duties are still substantial and will weigh on the Chinese economy. This year, we see it growing by 4.2%. The end of the US tariff pause is approaching, and new trade deals between the US and its most important trade partners have not materialized yet. Intense diplomatic efforts will be necessary to change that. With so many major geopolitical uncertainties over wars and tariffs, what should investors watch for? Until this year, US exceptionalism was a key factor behind strong market performance. But volatile US trade policy and Europe's strategic shift in CapEx means that portfolios now need more global diversification. Of course, it would be premature to move away from US assets, but there are new opportunities elsewhere, and we have progressively rebalanced our portfolios to seize them. Oil markets remain the key transmission channel for geopolitical tensions, but even there, the supply-demand balance has not changed. In fact, equity markets have shrugged off many of the year's geopolitical risks and fears about the path of the US economy, to focus instead on corporate sector outlooks. With resilient corporate fundamentals and monetary easing ahead, risk assets look supported. That's why we have kept our overweight exposures to global equities, both in developed and emerging stocks, and in sectors we still favor cyclicals. We also keep our overweight overall asset allocations to fixed income, favoring government bonds and investment-grade credit. Sovereign bond yields have held up through geopolitical turbulence, while concerns over US fiscal policy have pushed US yields higher, but to levels that now offer attractive returns. In currencies, the US dollar should now stabilize, and the Swiss franc, among other havens, should retreat as risk sentiment normalizes. We also expect gold to consolidate somewhat. Geopolitical and trade tensions will keep testing market resilience. We may have seen the worst of policy instability over the first half of 2025, but the environment remains highly fluid and enormously complex. That means that there are new risks. We have anchored our portfolios in solid global diversification and selectivity to navigate the changes that are underway. Thank you so much for watching.